The first learning objective is to prepare a segmented income statement using the contribution margin format and explain the difference between traceable fixed costs and common fixed costs. A segment is any part or activity of an organization about which managers would like to obtain cost, revenue, or profit data. Examples of business segments might include a division of a company, a sales territory, individual stores, service centers, manufacturing plants, marketing department and accounting department, individual customers, or perhaps product lines. This slide illustrates Superior Foods, which might segment its business by geographic region. We've got an East, West, and Midwest and Southern region. And then within each region, there's the West region. We've broken that down by states. So we could segment by geographic regions. Superior Foods could also think about segmenting, say, by customer channel. We've got convenience store sales, supermarket chains, wholesale distributors, and drugstores. Those could be our 4 different channels. And then within a channel, we might segment further by supermarket chains, A, B, C, and D under the supermarkets. We're going to find there's 2 keys to building segmented income statements. First, we want to make sure we use a contribution margin format because it's going to separate our fixed from our variable costs, and it will enable us to easily calculate our contribution margin. And remember, our contribution margin is especially helpful for decisions involving temporary use of capacity, taking on special orders, pricing our products, etc. Second, we're going to want to separate traceable fixed costs from common fixed costs, because traceable fixed costs will go away if a particular segment goes away, but common fixed costs will not disappear if a particular segment is discontinued. Let's look at that a little further. A traceable fixed cost of a segment is a fixed cost that's incurred because of the existence of a particular segment. For instance, the computer division incurs certain costs, and if the computer division segment were eliminated, that fixed cost would disappear. For instance, for the computer division manager is a traceable fixed cost, because if we got rid of the computer division, we would have no computer division manager. The salary of, say, a Frito-Lay's product manager at PepsiCo is a traceable fixed cost. We can trace that to the Fritos business segment of the Pepsi-Cola company. The maintenance costs for the building in which a 747s are assembled is a traceable fixed cost, because if we discontinued the 747 segment, we would no longer need that maintenance facility. And our common fixed cost is a cost that arises because of the overall operations of the company, and it wouldn't disappear if a particular segment were eliminated. So going back, we eliminated the computer division, meant no computer division manager, but we still have a CEO. So the CEO salary of General Motors would be a common fixed cost of the various divisions of General Motors. The cost of heating a Safeway or Kroger's or a Wise grocery store is a common fixed cost of the various departments, groceries, produce, and bakery, because even if we didn't have a produce department or a bakery department, we would still need to heat and light the grocery store. We sort of touched on the concept of a common fixed cost when we looked at the cost involved in selling a gallon of milk and a tube of toothpaste. We said both of them take up space in the store, and so that rent or depreciation on the store is a common fixed cost. If we discontinued or quit selling toothpaste, it wouldn't change our total occupancy costs. The same is true if we quit selling milk. However, if we quit selling milk, we could get rid of the cost of the refrigeration units that the milk is stored in. So that would be an example of a traceable fixed cost. One thing that's important is to remember that traceable costs depend upon our scale, or from what level we're looking at. Traceable fixed cost of one segment may be a common fixed cost of another segment. For example, consider the landing fees paid to land an airplane in an airport. Those landing fees are traceable to a particular flight. If we don't land the plane, we don't have a landing fee. But that landing fee is not traceable to first class passengers, business class, or economy class passengers. So again, that traceable fixed cost could be traced to an individual flight, but not to passengers on the flight. We're going to look at that a little bit further. We're going to look at an electronics division and some traceable fixed costs between some product lines. Our segment margin is important because it sort of tells us the long-run profitability of a business segment. And we calculate our segment margin by subtracting our traceable fixed costs from the segment's contribution margin. And again, it's the best gauge of the long-term profitability of one of our business segments. So to summarize, our fixed costs can be broken into two parts: traceable fixed costs and common fixed costs. We're going to want to allocate traceable fixed cost to segments, but we don't want to allocate our common fixed costs. Let's consider a warehouse that stores and sells pipes. We've got 9-inch pipes, 12-inch pipes, 18-inch pipes, and we have a 10,000 square foot warehouse. And we lease that warehouse at a price of $4 per square foot. So in total, we're spending $40,000 in rent. If we were to use an activity-based costing system, we might allocate the cost of leasing that warehouse to our three products, 9, 12, or 18-inch pipes, based on the number of square feet that those pipes take up in our warehouse. However, if we were to suddenly discontinue carrying the 9-inch pipe, our $40,000 cost wouldn't change. Our overall rental cost would stay at $40,000. This would be the example of a fixed cost that we need to be careful in terms of how we might trace it to individual segments. So with respect to our pipe selling business, this would be a common fixed cost. Now, if we were to eliminate 9, 12, and 18-inch pipes, then all of those costs, the full $40,000, could be discontinued. Let's consider the segmented income statements for Weber Inc. It has two electronics divisions, a computer division and a television division. Here's our segmented income statements for Weber. The overall company has sales of $500,000, and that's broken down between our television and computer divisions. And then each of our television and computer divisions, we can subtract our variable costs to get our contribution margins for each of our divisions. Then we will subtract the traceable fixed costs from each one of the divisions. And notice the television division then has a segment margin of $60,000, and the computer division has a segment margin of $40,000. In total, then, we have a company-wide segment margin of $100,000. After we then subtract our common fixed costs of $25,000, we will end up with our overall net operating income of $75,000. The $25,000 in common fixed costs should not be allocated to the divisions, because even if we were to get rid of the television division, the $90,000 in traceable fixed costs will go away, but it wouldn't change our overall common fixed costs, which will remain at $25,000. As we mentioned earlier, fixed costs that are traceable at one segment can become common if the company is divided into smaller segments. Recall our landing fees and our airplane flights. It's traceable to a flight, but it's common with respect to passengers. Let's go ahead and see how that might work looking at our Weber example in a little bit more detail. We're going to assume the Weber's television division has two product lines, an LCD product line and a plasma TV line. We're going to want to look and see how that $90,000 in traceable fixed costs for the television division can be broken down between the two product lines. And in looking at this partial segment income statement, we can see that the LCD has $45,000 of that traceable fixed cost. The plasma has $35,000 of the traceable fixed cost, and the remaining $10,000 is a common fixed cost of the television division. So again, in total, $80,000 in traceable fixed cost plus the $10,000 in common fixed cost equaled the $90,000 in traceable fixed cost that was being assigned to the television division. Common costs should not be arbitrarily allocated to segments based on a rationale that someone has to cover the common costs for two reasons. First, the practice might make a profitable business segment appear to be unprofitable, particularly if that segment's eliminated and revenue lost may exceed the traceable fixed costs that are avoided. Second, allocating common fixed costs will force managers to be held accountable for costs that they can't control. Let's go ahead and look at an example. Let's take a look at, we've got an income statement for Hoagland's Lakeshore Bar and Restaurant. And we've got the total income statement broken down into a bar and restaurant segments. Our first question is how much of the common fixed cost, the $200,000 in common fixed costs, could be eliminated if we close down either the bar or the restaurant? And the answer to that question is none of it. Remember, a common fixed cost can't be eliminated by dropping one of the segments. Suppose we did allocate the common fixed cost of $200,000 on the basis of square feet, and our bar occupied 1,000 square feet and the restaurant 9,000 square feet. How much would we allocate to the bar? Well, in that case, we would allocate 1/10 of the $200,000, or $20,000 would be allocated to the bar. And here's a look at our income statement if we allocated those common fixed costs. Now suddenly we see that the bar looks unprofitable. It has a $6,000 loss. However, we need to be careful with this. And if we were asked the question, should the bar be eliminated? If we looked at this income statement, our initial reaction might be to say, yeah, we ought to close down the bar because it's operating at a $6,000 loss. But would that be true? Not at all, because if we eliminate the bar's segment margin goes away, and that segment margin of $14,000 was helping us to cover our common fixed cost. And notice our profit before eliminating the bar was $44,000, but once we drop the bar, our profit drops to $30,000. And again, that's because the bar is generating a segment margin of $14,000. And that $14,000 is helping us to cover our common fixed costs. So without that $14,000 segment margin, our profit drops from $44,000 to $30,000.